My name is Martin Frewer. I'm a global commercial director of the principal trading groups for ABN AMRO Clearing. I'm very happy to be joined by Daniel Needson, who's principal strategy analyst at Optiva, Julian O'Leary, who's chief operating officer at GH Financial, Anix Krunik, who's head of equities at LCH, and Nicholas Bertrand, who's head of markets, derivative markets at Borsa Italiana. Well, it's been one heck of a year, 2020. We're going to be looking back briefly. We're then going to look at trends, themes, and new products to be looking forward to in 2021. So it doesn't seem like 9 months, but it seems far, far longer, to be honest. But back in March, you have to remember that global volumes exploded to record levels on the back of the global pandemic. We then all went into lockdown. During that time, equity indexes collapsed by an average of around 35% around the world. Difficult to believe when you now see the S&P nudging all-time highs. We had global rates collapse with government intervention and QI. The U.S. rates, again, in a very brief period of time, fell from around sort of 1.75% down to their current 25 basis points. So this extreme volatility obviously caused quite a lot of stress. I think we were talking earlier that we were all amazed by how the IT sort of setups all held up under this incredible volume surge. I think the other extraordinary thing is that actually when you see the recovery from that volume spike is how actually the in particular asset classes, how the volumes have continued to be very high. So even Q3 of 2020 has continued that trend. So I'd like to ask Daniel, because I mean, Optiva would have been globally at the front line, if he could just walk us through really sort of what happened in the timeline, the asset classes that were affected, and any sort of observations he had of that time.
Thank you, Martin, and thank you for the introduction. Thank you, FW, for having us in this panel. Indeed, 2020 was a year pretty unprecedented. That's a word that's been used very often. If you look at, from us as a trading firm, when all of this happened, first of all, of course, the business continuity plans came into full force, which, well, at least for us, all the operations were happening smoothly, luckily. I think one of our biggest concerns was that exchanges would possibly close, also because of political pressures. We worked quite a lot together with the exchanges to ensure clarity on that side, and also bring in the message that to continue to trade was ever more important, especially at that time. And especially if you trade options, that was of course very vital for your risk management. But at least this worked pretty well. We were quite concerned on that side, but we worked very well with the exchanges to ensure that continuity happening. So, and if you ask which asset classes were affected on the big volatility, actually all of them, and some of it in a different way. Equities are quite obvious. We had an enormous leg down, especially when it looked like most of the world was going to be in lockdown and severe movement restrictions, followed by quite a powerful leg up again, but different across the globe. But also what happened was a funding squeeze in US dollars, and that affected quite a bit of movement as well in March. We saw gold going down despite the risk to be going up, so you would actually expect it to go up, which it eventually did. There was a tremendous volatility in certain FX pairs, especially the less liquid ones, such as the Scandies, had an enormous squeeze down. Australian dollar made a big journey from one way to another. We saw a bit on some of the emerging market pairs as well, all caused by that dollar squeeze in March. And then if you go forward a bit into April, with a surprise fall in oil prices because of the production being kept up, that caused another wave of volatility, especially in the oil sector. We even saw negative prices in the front month oil futures because it was so heavily invested on the long side and needed to roll into further out contracts, also because of ETPs listed that had to move their open interest from the front month into further dated contracts. So definitely there we saw a market which was under too much pressure, and there was too much open interest by people that are not really involved in the oil market physically. So that was quite a unique kind of scenario, which definitely will require a bit of a closer look at to prevent that from happening again. Then if you look at fixed income and interest rates, also there we saw an enormous move. Obviously there were a lot of rate cuts, but also what happened on 30-year bonds, the initial reaction was risk off, so 30-year rates were going down. Then the bond vigilantes came in and started selling all long-term bonds because of the inflation risks, because of all the fiscal stimulus happening. And subsequently, the central banks intervened with all their QE programs, and all the 30-year rates went straight back down again. So there was unprecedented volatility in the fixed income space, not only in the high yield ones, where obviously that's related to the increased risk, but also even in just 30-year swap rates, 30-year bond rates. There was tremendous volatility never seen before, and I think exacerbated by some of the option positioning that was happening, massively short gamma on that side. And the last asset class definitely want to mention is dividends. Dividends were under tremendous pressure over this over these events here. I think it was exacerbated by exotic equity derivatives positions weighing very heavily. And on top of that, in Europe, there was political pressure not to pay out dividends for 2020, especially for companies that were receiving government aid. That actually made it worse because if it becomes a political decision whether to pay or not pay a dividend, becomes detached from the fundamentals. So even companies that might actually be sound enough and at least predictable in terms of their capital payouts, at that moment became very uncertain. So this definitely made it worse. Luckily, over this crisis in dividends, we had a very successful contract on Eurex, the dividend futures, where it was at least very transparent what was happening, much better than 12 years before during the GFC.
Thank you very much, Daniel. And Julian, what did you guys see from a general clearing member perspective?
There was a lot of sleepless nights during February and March, I must say. I mean, the volumes were unprecedented. Volatility was. You also had, reduction in clip sizes as well. So it wasn't just that the volume was going out, the amount of transactions it took to generate that volume increased significantly, as you'd expect in those kind of markets as well. So, yeah, it was very challenging. There was the industry got together, lots of conversations, conversations at FIA level. It wasn't just the FCMs; it was also, the exchanges trying to process the volume. We had margins going through the roof. There were stories of people being, days behind in clearing. I mean, it was a very challenging time to get through. I mean, volume's great. You want volume; it's good for everyone. But it did come with its stresses as well and its problems. I think it was the same all round. I mean, as we all know, there's only a few people in sort of the back office clearing space in terms of platforms, and everyone wasn't one firm was busy. Everyone was busy. Intraday margin calls. There's various conversations about those going on at the moment. So, having to move money quickly, large sums. And, at the same time, we saw IM, initial margin levels go through the roof. I think if you look at some of the index products, they went up over 100%. Obviously some of the bonds were up in the sort of 80s, 90s as well. And then the same in the energy sector. The energy sector didn't go up as much initially, but obviously that changed later on. But yeah, it was quite a year. I mean, as you've already pointed out, Martin and Daniel, there's a number of things, and it's not over yet. We still have, the fallout of the U.S. election. We still have the last pieces of Brexit to get over. I think a lot of people are looking forward to 2021 coming, and the virus life coming back to normal. You know, markets stabilizing a bit. Yeah, so it was good. It was an interesting year. I'm not quite sure I'd want to repeat it, but
thank you, Julian. I mean, before I let Alex sort of talk about the sort of the changes in the initial margin, one thing I'd like to sort of pick up on was when you talked about, you know, some of the GCMs being behind in clearing. And one of the problems that we faced was actually with the brokers. In other words, the brokers execute and then they give up and that for their clients, and then obviously they depend on their clients' clearers taking that business in. And what we find was that a couple of the big GCMs, because they had outsourced clearing services, those outsourced service providers were unable to keep up with the taking in of the orders. And then this sort of defines the sort of market we're in at the moment. In other words, it's very, very intertwined with other asset classes. And at the same time, we were having issues on equity settlement. And it sounds bizarre, but we had about a 10-day sort of lead in to the final lockdown. I think it was on the 23rd. And then the issue was exacerbated when obviously those providers who had Indian offices, and the Indian lockdown basically happened overnight. So all of a sudden, an awful lot of these sort of service providers were unable to settle their equity trades because of Indian issues. So what was happening is that you were having risk departments who weren't accepting orders in on the futures because, of course, the settlement issues were happening in other asset classes. So that's where we found a lot of stress. I mean, it was just one of the stresses, but that was where, you know, a lot of the big IDB brokers were having huge margin calls because, of course, those positions that are falling back onto their principal account. I mean, it all was through eventually, but it did create, again, another bit of stress. Anyway, sorry, Alex, talking about initial margins and the CCPs, I mean, they did come under a bit of flack. I mean, what are your sort of observations under that, and how did you get on at the LCH?
Okay, so from an LCH perspective, Martin, I mean, pretty much agree with you know, what Julian and Daniel have said. I mean, like any other, I guess, financial market infrastructure, we saw huge levels of volatility across all markets and obviously across all asset classes. And this is pretty consistent, I guess, with, you know, with our peers in the market. You know, from our LCH margin perspective, you know, the good thing here was that our margin models and processes remain consistent and resilient. You know, we didn't change, you know, when we calculated our margins, we didn't change any of our VAR models in terms of margin. And to be honest with you, maybe it's us at LCH, we certainly didn't receive any flack. We got a lot of commendation from the regulators. Obviously, you know, with these huge volumes, I mean, in March, we saw record volumes across all asset classes, and in equities in particular, we saw probably 200-300%, you know, increases year on year and month on month, which was, you know, absurd volumes. And our margins really didn't increase anywhere near those numbers in terms of percentages. You know, probably 18% was our average increase from Q1 to Q2 this year, which means that, you know, we have anti-procyclicality built into our models. And for those people that may want to know what that means, it really means that we are a little bit more conservative in the day-to-day business. And when, you know, so when we get peaks, you know, we don't have surges in our margin. I mean, obviously there was a lot more volume. So in terms of our capital and liquidity that we were holding during the peak, you know, on average, we would probably hold 82-83 billion in cash, you know, euro equivalent. During March and the beginning of April, we were probably at 100 billion plus all the bonds that we had as collateral. So there was a significant increase. The other thing that we found, which was crucial to us, is really, as already mentioned, our systems really withstood the test of time, because on the 9th of March, we launched our new Equity Clear platform. First day, record day, second day, record day, you know, and March the 12th, which happened to be the, you know, record day of all time. You know, we did 18.2 million trades that day. Our average day was 5.5 million last year. No latency, no outages. So I think actually, and not just LCH, I think all of the CCPs did very, very well, and certainly did a lot better than in 2008. I think we were a lot more prepared for these kind of surges, and on top of all of the kind of volatility and stress in the market, you know, most of us ended up working from home, and that was a real challenge. You know, getting people accustomed to working from home, giving them the right tools, giving them access to the systems, etc. That took a few weeks, but I'm glad to say that we've done our job well, and look forward to some of these stresses getting out of the market and coming back to some normality in 2021.
Just sort of moving on and going into the current trends. I mean, Nicholas, one of the things that we hear a lot about is the current trend in retail access to obviously equity markets and derivative markets in the US. I wonder if you could comment on that, and why aren't they more proactive in Europe?
Yeah, well, actually, definitely. I mean, when I look at trading volumes, this point is really strong in 2020, because the biggest increase in trading volumes in the European landscape are the mini DAX contracts, which is nearly up 50%, and the mini FIB, our mini contracts on Borsa Italiana, mini futures contract, which is up 20%. So that shows that those retail targeted products have done really, really well. In a market that overall in 2020, I mean, it's not that fantastic. When you look at equity derivatives growth in terms of volume, you probably have very high open interest, but the volumes was slightly disappointing in 2020. But I think what really set the tone in terms of the trend was the acquisition early in 2020 by Morgan Stanley in the US of E-Trade, right, for $13 billion, which clearly, that is a topic of the digital native and their emerging wealth, and how you can, take advantage of this by integrating the service into a more bulge bracket, brokerage house, such as what they are doing. But this is quite, an important factor in the growth of the U.S. markets. And I think in Europe, we are starting, to see, some follow through. Some markets are more developed than others. So the Italian market, for instance, is quite well known, is one of the biggest markets from that standpoint in terms of the activity of private investors. So we can look at for instance, the AIM, Italy, which is our small and mid-cap cash market. 38% of the volumes are made of private investors. And when I look at the mini FIB, the mini futures on the FTSE MIB index, this is 28%, which is, very significant. And across 2020, we've seen not only the doubling up of the number of open accounts by Italian retail online brokers, but also an increased market share and an increase of interest on more sophisticated products. So I think to answer your question, I think there is a trend here, definitely globally, but that Europe is catching up, and that it's an area that we should, as a community, pay attention to. We should, for instance, look at education, formation, functionalities, the products that we offer as well, to really adapt the market to this emerging change of the client base.
Yeah, no, I agree. I mean, you see a lot of these now app-based sort of retail platforms. That the worry in a way, though, is that, and okay, in the UK, there's been the sports betting, there's been the CFD markets, all the rest. The worrying thing in a way is trying to get that business into, say, the options market. I mean, it used to be there, but at the moment, it's whether it's from the regulatory standpoint or whether it's just that sort of retail base is now. But I agree with you. Moving forward, I think it's more of a question of sort of education. I think also a certain amount of it's up to us to actually embrace the regulations and make sure there's clarity. I mean, looking at it, Daniel, from on your side, I mean, what would you say also needs to be done to attract more retail? I mean, if you look at, say, the CBOE derivatives came out with a graph that showed the exponential rise in retail participation in the equity options market in the US, and yet it's very much flatlining here in Europe. I mean, do you have any suggestions or any ideas that how it can be sort of expanded to the retail?
Thanks, Martin. the sell side here, so I have ideas, but it's still a little bit of speculation here. But I do feel that the big difference between the US and Europe is, first of all, say the companies that are listed in the US are much better known. There's a lot more PR around it. That's actually a little bit of a pity, because if you look at Europe, especially I think one of the trends will be the green transition. I think there's quite a few interesting investment opportunities around there, but they just lack the PR. I think the US is a lot better at marketing their own companies. So there's something that we can do there in combination with education. Another factor we need to look at is the barriers for private investors in Europe to be able to trade derivatives on exchange. That depends a bit per country. In some countries, the barriers are not that big, but in other ones, they are so large that retail investors actually do want to have exposure. They go into alternative instruments that actually have a higher risk, for instance, warrants or CFDs. I think this is something the exchanges will need to look at, and also the regulators, to see whether this is really what we want, whether we want to funnel that back into a more regulated environment together. Because these kind of instruments are not allowed in the US, and I think that's a big difference between Europe and the US.
No, I agree. I agree.
To follow up,
yeah, go for it.
Sorry, just to follow up, Martin, on what Daniel was saying. I think really it's a question of names, right? We definitely don't have enough publicity on the names that are actually currently available, but we also don't have the big names, right? So, and I think we could be thinking about Capital Market Union, you know, as a number of initiatives that will eventually solve that issue. I mean, it's going to take time, but we really need to, you know, we need to look at the stocks of our stocks and get, you know, an offering to the trading community and the investor community more than the trading community that is more representative of the European economy, right? And I think this should be a top priority. Because as derivatives exchanges or derivative users, you know, we can only do so much, right? We can train people, we can educate people, we can speak about markets, but we need the raw material. And I think this priority from a European Union standpoint is a very important one to back as stakeholders. And will, if successful, provide for this lack of raw material.
Yeah. I want to take a step back, because this is very important to basically Julian, myself, and Alex. Is the low interest rate environment and its effect that it's going to have on, well, especially your business and not my business, Julian. I mean, have you got anything to comment on that?
Well, it's challenging. It's very challenging. We all understand that, you know, a lot of the FCMs, a lot of the models are based around interest. You know, we must also remember that, you know, the CCPs make money this way as well. There's a combination of factors as interest rates drop. You know, I worked at an exchange, you know, for many years, and they've had the same conversation with FCMs, and now I'm sitting on the other side. You know, it's out of most people's controls. Some business models are built around, you know, low commission rates based on the interest income they're making on the cash and deposit. If that goes away, what happens then? Do the business models still? Again, not everyone follows that business model. It's different for different firms, but it's certainly challenging. And then, you know, it's not just the sort of revenue that, you know, people like FCMs, clients, banks, CCPs make. It's also, you know, what's the impact to yield curve, to, you know, sterling contracts, Euribors, Eurodollars, these fixed income products that, you know, for many years, you know, have generated huge volumes and huge market participation. I mean, what happens now is, I mentioned in one of the previous discussions, and they were talking about, well, perhaps there is still inflationary pressure out there, and, you know, the yield curve being so flat for so long could change quite quickly. I mean, I hope so. You know, it's great to see volatility. The last thing you want to see is a flat yield curve on a short-term interest rate contract. That doesn't help anyone. So, it'll be interesting to see what happens next year. Again, these are unprecedented times, in my opinion, and I think perhaps, looking at a flat yield curve, there may be some movement there in the future, and it's not that we're being naive, but just being a little cautionary. But the impacts are everywhere from that.
Yeah, I agree. I mean, if you look at the volumes in some of the big interest rate contracts, I mean, they're basically incredibly disappointing this year to what they have been from the norm.
As well, do you need an option on something that's not going anywhere? We've seen this before, though. This isn't new. We've been down this path. And again, I don't think anyone can predict what will happen next year or the year after. But looking today at a snapshot of the yield curve, it's not very well. In North America and Europe, it's not very exciting.
Yeah, Alex.
From our perspective, you can imagine, in particular in the cash equities business, making money out of the clearing component is very difficult at the best of time. It's so competitive, and probably the clearing fees over the last 10 years have probably gone down tenfold. So we do rely quite heavily on the reinvestment dollars that we get from reinvesting the client's cash that we receive in variation margin and part of the default fund. And I mean, the other challenge that we had during this volatile period is obviously we've kind of most of the CCPs have become safe havens for the cash. So a lot of people are dumping a lot of cash with us, and obviously, unlike a commercial bank, we have in many cases a lot more restrictions in terms of where we can place and who we can place that cash with, in terms of central bank, and obviously the different CCPs, the setup in different CCPs is very can be very different. So for example, LCH Limited, we don't have a banking license, so for us we don't have it becomes a challenge in terms of reinvesting this cash. On the other hand, for example, LCH SA, our Paris CCP, they have a full banking license, full access to central bank money, to place as much money as they want. So for us, that component becomes a lot tougher. But nevertheless, what's probably made up for the reduction in margins due to the low interest rates is obviously we've taken in a lot larger sums of capital in and liquidity. I've seen some estimates out there by FSB and ESMA. 2 or 3% of all banks' cash ended up being with one of the CCPs, which again may not sound a lot, but it is a lot. Seeing it from our perspective, sitting on 100 billion in cash is a challenge definitely for our front office to reinvest that cash on a day-to-day basis.
So Daniel, looking at market trends, I mean, do we expect volatility in the equity and index markets to continue? I mean, what are your thoughts looking forward to next year?
Well, it's a little bit difficult to look at that forward. I think we had an interesting conversation earlier in this session from Elga Barge, basically telling us that this is not a recession. This is a very different style of recovery that we are seeing. Of course, the latest volatility event was from the U.S. elections in the run-up to it. Eventually, it didn't cause too much volatility, although the announcement of the vaccine on the 9th of November caused a high volume day with equity markets going up substantially, especially some sectors. If you look at it now, 2021, I think we will wait to see what happens with the vaccine rollout, how effective it is, and how quick things are starting to get back to normal. I think we're all looking forward to that, of course. Then we'll see how the new U.S. administration will do and what direction they will be heading. There's still quite a few geopolitical challenges ahead. There is a number of European developments that still need to play out. The Brexit is still not done and dusted with, although this might take on for quite a long time from now. Also, I think it's important to realize that if we have this recovery, the price pressures and for how long will central banks ignore this, and when do they start to become nervous? This could be a next pressure point at some point. It's very difficult to time. But say negative real rates of like 2% are probably somewhat acceptable. But if we are having negative real rates of like 5%, are they still comfortable then, or are we going to see nervousness and hedging as a result of that? That will be a very interesting theme for the, say, 2021 or maybe a bit beyond that.
Yeah. And Julian, are you guys seeing much? I mean, are you seeing sort of migration from the LIBOR benchmarks to the new, the SONIA, SOFR, IONIA benchmarks on the fixed income interest rates?
Not too much at the moment, but again, I think that story's only halfway through at the moment. Sterling to SONIA, dollars to SOFR, each one, and again, Euribor plus. I mean, everyone's got a slightly separate story. I think that'll be really interesting for next year. We've seen these sort of things before, and again, change as well, as long as it's warranted and well managed, generates opportunity as well. So I think that's a positive for next year. It's well documented, the issues with the LIBOR and the previous calculations of it, and your reference rate. Okay, look, flat yield curve, but there is some change going on out there. I mean, that's got to promote some sort of opportunity. It's just to be there when it happens.
Yeah, no, I agree. We haven't really seen the sort of what I say a weight of money happening on it. Obviously there are guys waiting to arbitrage it. I mean, the same with the FX.
Yeah.
Trading the spot FX on against the cleared. And what about you, Alex? I mean, looking forward, have you got stuff that you're looking at?
Yeah, absolutely, Martin. I mean, like you say, we've had so much volatility coming from different areas this year. I'm sure we're not going to get a repeat kind of across 4 or 5 different kind of triggers of that volatility. We've had obviously COVID, the COVID vaccine, US elections, Brexit in 1 year. It's a lot of things to take into account. So, from our perspective, kind of looking forward, we're really looking at more of the OTC markets coming into the cleared space. In particular, on the back of the UMR, obviously these are not mandated instruments, but for our clients and members, they get huge capital savings, huge margin efficiencies, and obviously operational efficiencies, on the back of UMR. So we will definitely see trends of more FX being brought into the cleared space. We are in the process of launching a term CFD, a cleared product or total return swap. To most of you is probably more familiar as of early part of next year, and we definitely think that will play a big part in terms of our development and growth. We're starting off with covering the European markets. Obviously the main index securities 600-700 universe. Then we will look at US and elsewhere. So I think that for us will definitely be a direction that we will be heading in. From a pure equities perspective, again, it's really about being resilient. I think we will see bigger flows than, say, in 2019 next year. I don't think we'll see a repeat of 2020, but I still think we will be probably surpassing 2019, which was again a very good year. So we're looking forward to the markets continuing in a similar vein to the way they're finishing this year, because we're definitely not seeing any kind of drop off in volumes. We're still doing 2 or 3 million on average more trades than we did in last year at this time of the year, which is significant.
Thank you. And Nicholas, I know you can't comment on what's happening at the moment, but what about the consolidation of exchanges? I mean, there still seem to be quite a few exchanges in Europe. I don't know what is the last count, 6, 7? I tried to count the other day actually, but I mean, do you see any more consolidation from an exchange perspective?
I think this is the trend, and I don't think you should be looking at Europe in particular, but generally speaking, globally, I mean, there is a trend of consolidation of exchange and infrastructure companies in general. That this is definitely not the end of it. Probably, the market is more concentrated than it used to be. So the antitrust point is always a point, and I mean. An example is actually Refinitiv LSE deal, which saw a divestment as a result, and we are still waiting for the authorizations on that point. But what I see is probably a different type of consolidation. You know, not maybe strictly speaking between exchanges, but looking a little bit more on the horizontal or the vertical of the industry. So, for instance, you could look at you know, the link to the brokerage side. Anything that can provide with a better interaction and better connectivity with the clients. So you've seen Deutsche Börse announcing in September its majority position with quantitative brokers. So it's more in the fintech execution algorithm space, but very well suited to you know, derivatives exchange such as Eurex. That's something I can see. You could see also the ISV. So from the connectivity link, there are also discussions ongoing on this point, and probably, you know, one of the key points is the IP area, and it's an area where London Stock Exchange Group has moved very early with you know, foresee and also, you know, other acquisition in that space. But it's definitely, you know, an area that is you know, regarding data, indices, and what you can do with the you know, with you know, transforming and creating a new value linked to exchange data. So I think there will be always M&A, and probably we will see something that is more you know, more than direct exchange to exchange. Is probably, you know, a little bit different type of M&A for the future.
Yeah, no, interesting. And globally, I mean, Daniel, opportunities. What are you looking at? I mean, I see a staggering amount of growth in Chinese agricultural futures, and you know, China as a whole, is it a continent or a country? I mean, the explosion in futures volumes there. You see again that there's some of the smaller contracts in, say, Moscow. They have a mini energy contract. I mean, the volumes are huge in these places. Are you guys looking at any sort of global opportunities?
Thank you, Martin. Well, Optiver has been present in Shanghai for quite some years now. So we have an office there onshore, trading the many markets within China and the mainland. So we've been part of that growth already for a number of years. What makes China interesting in the international context actually is that the commodity markets in China have been developed at a very rapid pace, and they provide a lot of different products, even more liquidity than in, let's say, in the non-Chinese markets. And what you especially see is a more consolidation between dollar-denominated commodities on the CME and ICE and renminbi commodities in China. So there's more and more, say, prop traders and other investment firms looking at exploiting the differences in the pricing, in term structure, and now also with the launch of options in China, commodity options, on a number of products, where an equivalent is also listed on the U.S. exchange. You get even more interesting combinations to look at, because if you have, for instance, gold denominated in renminbi or gold denominated in US dollars, and you look at options, and there's a correlation between the exchange rate and the underlying asset, then obviously it has an effect on the vol curves that you would see in there. And these kind of things are becoming more and more interesting, not only for prop traders, but also for hedge funds, vol hedge funds. And I think that trend will continue once it becomes, step by step, it becomes easier and more accessible to trade Chinese products from outside of China. And so I expect to see more of that. Another part where you see growth is India. India actually reformed some of the derivatives markets, making it a bit easier to trade and also to create better offsets between certain derivatives positions. The volumes have been are up there in the second half of 2020, which is pretty unique, because Europe volumes, if you look at second half of 2020 only, they are down. So I think India is a growth market. Brazil as well. Brazil is a growth market. It's been already pretty solid and very well-functioning market for many years, but that's continuing. So that's I think where the growth areas are actually not in Europe, and that's, as a European myself, I find that disappointing. I hope we can turn the tide. Maybe the green transition is something that we can have a look at. I expect energy trading to increase, and especially in power and in carbon credits. I think that is an area where Europe is leading, and I think that would be a good opportunity to look at.
Yeah, no, I agree. I mean, we've seen a huge uptake in Brazil, and we do the internationalized contracts in China. We haven't got around to it in India yet. I've been there a couple of times. It's not easy. You guys do quite a lot in India, don't you, Julian?
Not so much on the Indian markets, no. I mean, we've looked at them carefully. I mean, what you've got to be careful of, I mean, NSE is the biggest exchange in the world by volume. But then if you look at the contract size, oh, okay, it's not, you know, it's, I mean, I've got even some stats in front of me that show, you know, it's, in terms of contract size, it's 26%, volume, contracts traded, it's 26, in terms of revenue, it's 2%, you know, it's tiny. So you've got to be careful. I mean, you're looking at things like Zhengzhou, Dalian, INE, you know, there's some great contracts, PTA products, and, you know, but you've got to take a step back and look at the contract size, look at the commercials of trading that product. So we're looking at those, you know, but, you know, we follow interest. New exchanges, we've all been around that roundabout many times. It's always a challenge. You know, we know what it's like, you know, having worked on both sides of it as well. Again, I'll just echo a lot of the points Daniel made. You know, Brazil, again, as you said, Martin, a lot of interest out there. You know, there's challenges to these markets, both from a technology side, you know, interest rates versus clearing and price units, the complexities of the margin methodologies, the fee calculations. You know, these aren't easy things to support from a technical perspective. Some other exchanges, you know, there's access. You know, it's not as easy to access as it is, you know, your core European and US markets. But, you know, in some cases, that's where the opportunity is. I'd love to see more happening in Europe, but at the moment, we have more people asking questions about, you know, other Latin America and Asian markets.
Yeah.
And I think maybe 2020, I mean, is you know, with the performance of those markets, you know, has really shown the importance of market access, because you get the Nasdaq that's up 30%, you get the FTSE 100 that's down 15, China up 30. So there is a huge variation in terms of performance of markets, and therefore, what does it mean? It means that people will move from one market to the next, and therefore access will be a critical point.
Yeah, which is always a struggle, you know, but the way technology is, and, you know, the support of some of the vendors out there, it's relatively easy and not, you know, inexpensive, relatively inexpensive to access these markets. So the days of being stuck in, you know, let's go back a couple of decades in one pit and trading one contract have definitely moved on to the point where it's not multiple markets within a single exchange, it's multiple exchanges, but even, you know, southern, northern hemisphere, east, west, all on the same screen and easy to access for minimal cost.
Yeah, right. I just want to, before we sort of all wrap up, I want to go back to what Daniel was talking about with the green transition. He rightly talked about energy and the power contract. I mean, with Optiva, because you had a very good sort of seminar last week, what about the sort of the benchmarks that we were hearing before? I mean, are you guys proactive in that, Daniel?
Yes, we are, Martin. There's a number of ESG index contracts, futures contracts that were launched this year on the CME and Eurex, basically the ESG versions of the well-known S&P and Eurostoxx benchmark. And also on the options side, both on the futures and options side, we are supporting liquidity there. And you can actually wonder, why do we do this? Well, basically, we feel that this transition is happening. I think there's quite a bit of interest in investing in these benchmarks, and we want to basically do our contribution to reduce the cost and to increase the price transparency on that, because we are part of the capital markets. We all are here and all in different parts of it. And if you look in total, capital markets are, if in a good way, are a very powerful tool to direct energy, I would say, or potential in the direction that we want to develop our society in the future. So if we can direct the capital markets energy into the right things, and we can all do our bit, every one of us in the part that we are good at, I think we can definitely bring a more sustainable future to it. So this is the reason why we supported these contracts here.
No, it's very much one of our strategic pillars as well at ABN AMRO. Nicholas, from an exchange perspective, what are you guys doing?
Well, we focused a lot with FTSE Russell in 2020, and I mean one point of data that I think is really important is the amount of pickup of the integration of ESG into investment decision by the asset owners. So on the last survey we've done, I mean 72% were in the process of integrating or had already integrated. That's up 14% from the one last year. So I think it shows clearly that this is coming totally mainstream. I think on the derivative side and on the exchange side, so we are very active on the topic. We think that that this is absolutely critical. Sustainability is a critical topic for next years. I think on the derivative side, we are a little bit more in the wait and see, because we think that we still need to get more standardization before being able to really say, well, you know, this is the area and this is the way that people should look at that. It's still early days in my view, and so we are maintaining a lot of attention, but we don't yet have you know, a specific product to offer on our markets for now. Yeah. It may arrive soon, but I think it needs a little bit more breathing room. You know, I know a lot of exchanges have gone, you know, very quickly, but I think it needs a little bit more time.
Yeah. And Alex, is there any initiatives with you guys at LCH?
Yeah, I'd probably say, Marty, this is probably more of an initiative at the exchange level. London Stock Exchange, there's a big move towards kind of green bonds, and obviously from our perspective, it's just really kind of having the ability to clear those icings as they come on stream. So I think, as Nick already said, I think there'll definitely be more of a move into kind of green energy and kind of green bonds in the coming year or two, and hopefully that will increase the flow for the CCPs.
Great. Okay, perfect. I think that's us. I think time's up. Thank you so much, everybody.